Moving forward, what is this three process? The first and foremost is the first set of screening that is applied to any company is the business screening, or we call it sector screening. We can also call it a qualitative screening, which screens the company's business sector to ensure that companies which operate within specific business areas that are prohibited in Shariah are excluded from the investment universe. Later on, after this business screening, they will also apply the financial screening, which has 4 categories to it: revenue compliance screening, leverage compliance screening, and liquidity compliance screening, and as well as interest compliance screening. For the revenue compliance, based on Shariah principle, we know that income earnings should only be through Shariah permissible means. Like we mentioned, we can't earn through alcoholic sales, alcoholic beverages sales, or tobacco sales and stuff like that. But since a fully Shariah compliant company is scarce in the market, and most do not operate entirely in a Shariah prescribed manner, Shariah scholars have allowed a small percentage of impermissible income, which is here the revenue compliance 5%, if the core nature of the business is Shariah compliant. They base their judgment on this 5%. They base their judgment on a legal maxim, a qawaid fiqh, that says the majority has the ruling of the whole, or the majority counts. Moving forward, later on, secondly, for the leverage compliance and liquidity compliance, from a Shariah perspective, we know that all liquid assets, either cash or debt, must be traded at par. And consequently, because of this, a company which the majority of its assets comprise of cash or debt is to be traded, cannot be traded either above or below its book value. However, trading at par value in the current market condition is impractical due to the reality that the market price of shares tends to fluctuate, which result in the price not necessarily represent the book value of the cash and debts, but the forecasted cash flows or the expected price value. Therefore, one is unable to trade according to the par value of the company at the current market. And to relieve this issue, Shariah scholars place the 33% or the 50% threshold on the proportion of cash and receivable to the total assets, or to the market capital asset. And lastly, on the interest compliance, we know that dealing with riba is firmly prohibited, either by giving or receiving interest-based debts. And giving interest-based debts either through interest-based deposits or interest-based securities such as government or corporate bonds are all prohibited in Sharia. And again, due to public needs, Islamic scholars have defined a threshold signaling to which extent it is permissible, and here we mentioned is 33%. This threshold again acts to minimize the investment in interest-based deposit or securities, which also will reduce the income generated from riba. And lastly, the last process is dividend purification, which is income, whichever income that is generated from prohibited means will be deducted from dividends paid, and that income itself or that amount itself will be donated to the charity.